Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is James Emanuel, a private investor and the founder of Rock and Turner. James has thought deeply about many aspects of the investment world and is an active writer on his Substack, as well as being the author of a number of books. In this deep conversation, we discussed what led James to focus on investing full-time, why he decided to run what is essentially an all-cap global strategy, the reasons he has such a negative opinion of dividends, why he calls stock-based compensation the most abused aspect of corporate finance, and his newest book, Fabric of Success. And without any further ado, here's my conversation with James Emanuel. James, you've done a lot of things during your career in finance. What led you to focus on investing full-time?
So I've been involved, I qualified as a lawyer, but I never practiced. Instead, I went into finance and banking, and I've been involved in that industry for the best part of 30 years. And during my time, I've been involved in a multitude of asset classes, from fixed income, equities, commodities, foreign exchange, and even some really exotic derivatives, including weather derivatives, believe it or not, for Enron as a client before they went down. And people say to me, how do you trade all these different things? And to be honest, I say to them, well, I don't trade all these different things. I only trade one thing. I trade risk. That's what trading is all about. Any risk at the right price makes a good investment, and it's all about risk-adjusted returns. That doesn't mean avoiding risk. It's about understanding risk and being able to price it properly. You just got to think about an insurance company which underwrites huge catastrophic tail risks, or life assurance companies which they underwrite unavoidable risk because sooner or later we're all going to die. These are businesses that thrive on pricing risk. Even a restaurant owner down the street is taking a risk. He buys a property, he furnishes it, hires staff, stocks the kitchen. He has no idea that people are going to come to his restaurant and order any food. He's taking a risk. He's managing risk. And so investing in whatever you do in life, business-wise, it's all about managing risk. And that's what I do. That's what I can do. That's what I understand. So that's why I invest.
Interesting. And as you were developing your approach and philosophy, what were the critical experience or lessons that helped shape you as an investor?
Okay, that's a good question. So, when I started out in the world of investing many years ago, faced with thousands of public companies, I thought I was spoiled for choice. And in that kind of situation, it's very easy to buy into a false narrative or to follow the crowd by jumping on the momentum train. But it didn't take long before I realized that was a huge mistake. Intelligent investing means doing things differently. You can't achieve better than anyone else simply by doing the same as everyone else. So just consider, I don't know whether you're a Berkshire Hathaway shareholder, but in Buffett's 2022 shareholder letter, he said something which was really interesting. He said, our satisfactory results have been the product of about a dozen truly good decisions. Now, he's been investing for 60 odd years, so that's one every 5 years. Just think about that for a second. How many companies do you think he looks at in the course of 5 years to find one outstanding investment? And what that reveals is the undeniable truth that the vast majority of businesses are no better than mediocre, either down to their unit economics or else maybe they've got self-serving or incompetent management. And Peter Lynch is another one of my heroes. And he once said that if you look at 10 companies, you'll find one that's interesting. Frankly, I think it's less than 10%, but in any event, the point's well made. And Peter Lynch said the person that turns over the most rocks wins the game. And I absolutely love that metaphor because intelligent investing is like treasure hunting. It isn't easy turning over hundreds of rocks to find nothing of value underneath, but once in a while you strike gold. And that's what inspired the name of my fund, which is called Rock and Turner. And that's exactly what I do. I turn over lots of rocks.
That's funny. I didn't know that the origin story of the name. That's interesting. All right, so we've talked a little bit about your background and your philosophy and your mentor, kind of like your mentors from afar. Let's dig into the strategy. So you run what is essentially an all-cap global strategy. Why did you decide on that versus focusing on specific market cap ranges or geographies?
Well, the beauty of working outside of an institution is that I'm unconstrained by arbitrary corporate rules. So I set my own rules, and only those that are necessary to manage risk. I can fish in shallow waters where institutional investors don't fish. So just think about this. An institutional investor with a small fund, maybe $2 billion assets under management, And maybe he's required to diversify across 25 positions according to the constitution of the fund, which means that his average position is going to be 80 million. But the constitution may also say that he's not able to have a holding of more than 10% in any particular company because of the regulatory and legal obligations that would give rise to, which means that he can't invest in any company with a market cap under 800 million. I can do that. And so why wouldn't I fish in waters where some of the big institutional investors can't? That in my mind is a fund manager's problem because he misses out on some great opportunities. And remember, every large cap company started as a small cap at one time, and transitioning from a small cap or a micro cap even into a large cap is where you get the multiples of growth, which is ideally what we're all looking for. But why would I only limit myself to small cap stocks? If I see a good opportunity, I don't care if it's micro cap or mega cap. And I have positions in companies with market caps measured in tens of millions, and others in the $1 trillion range. I've got a position in Amazon, for instance, and Berkshire, which recently crossed through the $1 trillion market. So for me, size isn't so important. Incidentally, that's also what I tell my wife. In answer to the geographic markets question, it's far more nuanced. So opportunities appear everywhere. So should we simply ignore them when they appear? As I said earlier, for me, it's all about risk-adjusted returns. So, for instance, both China and Japan are, relative to their US peers, undervalued. But they also present a different set of risks that need to be properly understood. So let me explain that in a little bit more detail. So let's consider cultural risks in the context of Japan, which perhaps helps us understand why the Japanese market doesn't command the same multiples as the US. So, Japanese people are very polite, but they're hierarchical and very, very political in the way that they conduct themselves. I should know because I worked at a Japanese investment bank for several years. So people tend to progress in all Japanese companies. People progress up the corporate hierarchy, typically not on merit, but based on how well they've been able to navigate internal politics. So there's a lot of cronyism involved. And it's considered taboo within a Japanese company for anyone to communicate with anyone more senior than their immediate manager. So, people tend not to challenge their superiors, even if the challenge would be valid and, arguably constructive for the business. So acquiescence becomes the norm. And what you end up with is a congenial, sycophantic kind of environment, where everybody's yes, sir, no, sir, three bags full, sir. And it becomes kind of a management bureaucracy, managed by proxy, particularly processes of proxy. People in Japanese companies, they know they won't get fired for following a process, but they may lose their job if they break from convention and they raise too many challenges. So you end up with a company full of automatons, and no one would excuse a poor performance by stating, well, I followed a process. But this is effectively what happens, and you're left asking, do you own the process, or does the process own you? And this obsession with process works in some context. Consider great Japanese company Toyota. It has the Toyota production system, which is often referred to as lean manufacturing, and it's become a model for efficiency and excellence the world over. And many companies outside of Japan have sought to emulate the Toyota production system, but few have succeeded. And it's because in Japan they've got a maniacal attention to detail, and it's created for them the world's leading auto manufacturer. But in many other businesses, this obsession with process simply acts as a drag on progress and evolution. The other key difference in Japan is that, rather than having an exceptional leader pulling the strings, like a Steve Jobs or a Bill Gates, as happens in the West, decision making tends to be by consensus, which implies lots of committees and plenty of compromise, which kind of reminds me, I don't know if you've heard the David Ogilvy quote. He said you can walk through any big city or park and you never see a statue of a committee because committees don't achieve anything. And that kind of really hits the nail on the head about Japan. They try to do everything by committee. Everything's consensus. And Japanese companies are typically run like collectives for employees. So the shareholder tends to be a really low priority. Sometimes they even see a shareholder as an inconvenience. And Japanese firms are historically reluctant to disclose critical information to investors, and they certainly limit shareholder engagement and influence. For them, it's all about long-term stability, and that's more important than growth. They're not risk takers, and they hoard cash rather than investing. Capital allocation decisions are really, really poor, which is one key reason that the Nikkei index has stagnated for the past 30 years. It really is unchanged on where it was in the late 80s. So let me give you a quick example. I was analysing a Japanese company just the other day, and it was a video games developer. And this company had a $76 million market cap. Now get this, its net current assets were 84 million, exceeding the market cap. 90% of those net current assets were cash and accounts receivable. And those net current assets, larger than the market cap, and the company had no long-term debt. And it's exactly what Ben Graham used to call a net. Essentially, you could buy the company, you could liquidate the assets, and you could walk away with more than you paid, which means you're effectively getting a business thrown into the deal for free, which has a long-term track record and enjoys both top and bottom line growth. So, you might be asking, what's the catch? And the issue, as I kind of explained, is the management. It's been hoarding cash. So the book value per share has doubled in the last decade, but capital allocation is so poor and the asset base isn't being used productively, that you buy into this company as a shareholder. What are you going to do? Unless you can extract the surplus assets or encourage the company to use them productively, it's just dead money. You don't really want to be invested in that kind of business. And there are two region-specific issues here. So first is the Japanese economy has been stuck in a deflationary environment since the 1990s. So if you think in an inflationary environment, cash loses value over time. But in a deflationary situation, the opposite's true. So there's no driver to encourage investment. And second, corporate management in Japan often doesn't have any alignment with shareholders. They rarely own any stock themselves. They simply work there as salaried employees. So they really don't care about the share price or the market cap of the company. And this explains why the share price of this particular company is exactly the same as it was a decade ago, and where it's likely to remain for the next decade. So it's just poor corporate stewardship. Incidentally, just kind of wrapping up on Japan, the Tokyo Stock Exchange, in concert with the Japanese government, understand that the way companies in Japan are governed is pretty poor, and they're trying to unlock value. They've introduced a raft of measures to bring about change and to unlock this trapped value in Japanese companies, and it is starting to bear fruit, which is why Buffett started to invest in Japan a year or so ago. I went into far more detail about this in one of my Substack posts for anyone that's interested, so I won't go into any more detail there. So let's kind of park Japan. But when exploring other geographic markets, it's important not to also fall into kind of a value trap, which is exactly the problem with Japan. A lot of these companies look really cheap, but they're really not. And the other factor when exploring geographic regions is, of course, the language barrier. So if I invest in a British or North American business, I can communicate freely with the senior management team, either in writing, over the phone, or by maybe a video call. But try doing that with a Japanese or a Chinese company. It's absolutely impossible. And so, on the subject of Chinese companies, I'm happy to invest in China if I see something interesting. But because of the communication issue, problems sometimes arise. So I discovered this really interesting Chinese company a year or two ago called Quifu Technology, which is listed, funnily enough, on the NASDAQ. So really interesting story. The controlling shareholder is a guy named Zhu Hongyi, Chinese guy, who sold his search engine company to Yahoo in the early 2000s for over $120 million, which is a huge amount of money for anyone. But given the average wage in communist China back then, it was an astronomical amount of money for a Chinese person. So he sold his company to Yahoo, and he then became the CEO of Yahoo China. And he served from 2004 to 2005, and then subsequently invested in other businesses with his kind of windfall cash and his newfound wealth. And one of those companies included this particular company, Quifu Technology, which is a capital-light fintech company that primarily provides credit technology services to facilitate lending between banks, financial institutions, and borrowers. And some of the other key people appeared to have a JP Morgan background. So everything looked really, really good with this particular company. The numbers were really impressive, and it looked way, way too cheap because, China's been sold off in recent years. Sure. It's just become unfashionable. So I value this company at about $40 a share. And noted that it had actually traded there in the past as recently as 2021, which kind of confirmed maybe my valuation. But the stock was trading at about $16. So I thought, okay, I'm going to open a position in this company, which I did. But I couldn't reach out to management as I usually would with a Western company. And so I took the plunge. I just had to have faith based on my own analysis. But a week or two ago, there's an American short seller, and they published a report. It's Grizzly Research. I don't know if you know those guys. And they published this bear report making all sorts of allegations about impropriety at the company and in relation to the controlling shareholder, this guy, Zhu Hongyi, the guy from Yahoo China. And of course, never having spoken to the management with so much on the line, and I was unable to kind of verify whether this report was wrong or right, or I had no choice. The only thing I could do was exit the position, so I did. Now, fortunately for me, China's had a bit of a rebound in recent weeks, and it was trading about $32. So I managed to double my money in a year or so. But I like to hold and buy. I like to buy and hold for the long term. And I thought that this company, if my analysis was right, still had a lot of way to go ahead of it. But because I couldn't communicate with people in China, and most of their corporate information was in the Chinese language, which I don't read, I had no choice. I had to sell, so I'm out. So, long story short, my preference would be to invest in Western businesses where it's easy to communicate with management, and I can read all the literature relating to the company and do proper qualitative due diligence. But my willingness to explore opportunities in other markets resulted in a decent premium on this Chinese company, and so hopefully you'll understand why I don't ignore these opportunities. And so to answer your question, I look at all sizes of companies from microcaps to mega caps, and I look at any geographic region.
In that response, you mentioned your Substack. You write a lot on that Substack. And when I look through your articles and based on our conversations, I get the sense that you, one, have a quality bias, and two, that there are certain topics that you have very strong opinions on. I'd love to dig into some of those, starting with capital allocation. Why do you have such a negative opinion of dividends?
That's a great question, and it's a question on which I know that I disagree with a lot of other people. So let me give you my opinion, and people listening to this can form their own opinion. So prior to the 1950s, there was this prevailing belief that a company generating regular cash for its investors signaled its quality and reliability as a business. And during that era, companies were really heavy with tangible assets, meaning that organic growth was really difficult to achieve. Acquisitions were rare at that time, and share repurchases weren't yet a thing. So with excess capital accumulating on the balance sheet, returning it to shareholders became the default choice. So that's perfectly understandable. But today we live in a completely different world. So many of the leading companies have an intangible asset base, which is easy to scale. Mergers and acquisitions are commonplace, and share buybacks done properly are incredibly accretive to shareholder returns. But despite changing times, so many CEOs are still using their grandfather's playbook and defaulting to dividends, which is exactly what I object to. So if a company has the ability to scale and to deploy new capital at attractive rates of return, then reinvestment of retained earnings should always be the number one priority. So I don't know if you've ever heard this. This is one of those stories that circulates around, but the maths all adds up. So this really helps us to understand and quantify my view on dividends. So did you know that if you had a penny and every day that penny doubled, by the end of the month, by day 30, you would have generated $5.3 million from a single penny. I don't know if you've heard that before, and this may seem unrelated to the question you're asking me, but it's actually really, really relevant. Now, imagine that every time that penny doubles, you take half of the amount that's doubled out as a quasi dividend, while allowing the remainder to continue doubling for the same 30-day period. Now, can you guess what the outcome will be? I bet you can't. By day 30, rather than that penny having accumulated to being worth 5.3 million, it would have grown to be worth $1,278. An enormous difference, right? And we mustn't forget the accumulated dividend that's been taken out. So collectively, the compounding effect of growth on that penny and the dividend that you've extracted every time it's doubled would give you a total return of $2,500 on that single starting penny, which is a far cry from the 5.3 million had you not extracted anything out every time it doubled. And that's kind of a demonstration of how damaging extracting capital from a business that's able to compound can be. It highlights the incredible power of compounding and the drawback of interrupting it by extracting those dividends. And this is why in the Berkshire Hathaway shareholder letter, Buffett has always said, and I quote him on this, our shareholders will continue to save and prosper by us retaining earnings and compounding growth on gross, he uses that word, gross pre-tax dollars. So he sees it exactly the same way, but there's more to this. The story doesn't end there. So imagine the penny analogy represents these two companies, which are exactly the same in every respect, each generating 100% return on invested capital by selling the same service to the same target market. Everything is the same. The only difference is that one pays dividend and so compounds very much more slowly than the other. Now think about the relative growth rates of each company. What do you think that would do for valuation multiples? Do you think the company that turned a penny into 5.3 million would be ascribed a higher multiple than the company that only turned a penny into $2,500? Of course it would. Now combine the far larger earnings that the company that's compounding at a faster rate is generating with a higher multiple, and all of a sudden you can kind of grasp the multiplicative effect of why dividends are so damaging. They slow down the growth, earnings are lower, the earnings multiple will be smaller, and now you can kind of understand why companies like Amazon and Berkshire Hathaway that don't pay dividends have significantly outperformed the market. It's just simple maths. And it also helps to explain, and this is quite an interesting one, why European companies trade at lower multiples than their US peers. So many European companies erroneously believe that moving their listing to the US from Europe will miraculously improve their valuation. And what they fail to recognize is that their low valuation is invariably poor because of their poor corporate stewardship. So, allow me to explain. So many European companies feel obliged to pay healthy dividends. And on average, they pay far larger dividends than their US-based peers. Which, as I've demonstrated, slows down their growth. And interestingly, McKinsey did a piece of analysis where they sampled more than 2,000 US and European companies with revenues of more than $1 billion. So, these were reasonable sized companies. And they found that between 2014 and 2019, so a 5-year period, these large European companies were 20% less profitable, measured on a return on invested capital basis. They grew revenues 40% more slowly. They invested 8% less in terms of capex because, of course, they're paying out too many dividends. And they spent 40% less on R&D than their US counterparts. So, I ask you, is it any wonder that their valuation multiples are lower? They're growing far more slowly. And simply moving their listing to the US is not going to change anything. They need better corporate leaders. That's the kind of long and short of it. Now, that isn't all European companies. There are great European companies. I mean, think about Ferrari, for instance. I think that trades on an earnings multiple of about 45. So, there are exceptions, but generally the rule and why the indices in the US have an average multiple far higher than European indices is this very reason. It all comes down to dividends. So, what I'll say is there's a prevailing myth that the lion's share of an investor's returns flows from the reinvestment of dividends. But let's think about that mathematically. Dividends are reinvested by investors at the market price, which is often a multiple of book value. But retained earnings are reinvested by the company at book value. right? So that's a critical. So the company is able to reinvest on behalf of its shareholders at a preferential price. And in reality, it's the reinvestment of retained earnings, not the reinvestment of dividends, that drives exceptional shareholder returns. And so few investors appreciate that. And so, if I told you that Brian Kazanich, the former CEO of Intel, he was CEO, I think, from 2013 to 2022 or so, and he was largely responsible for the former tech darling falling from grace. And I won't dive into all the detail of what he did, but it's worth noting that he adopted a progressive dividend policy, and he consistently increased dividends sequentially, even as the company's fortunes declined. So, is it any wonder that the business struggles to compete anymore? When management takes a growth company and prioritizes dividends, any investment in that business starts to resemble a high-yielding bond rather than a growth-oriented equity, which is what we're all after. And just to give you another quick example, so in recent years, McDonald's took that high-yielding bond approach. Its quarterly revenues in 2024 are pretty much the same level as they were in 2010, so 14 years of pretty much zero growth. Why? Well, during that period, McDonald's paid out huge dividends, and its payout ratio has been as high as 80%. So, the cause and effect, as far as I'm concerned. Now, there are companies which I know people will object. People will say, what about those companies that throw off so much free cash flow that they have enough for reinvestment and buybacks and still have some left to pay dividends? Now, that's fine. Apple is a great example of that kind of company. But these companies are exceedingly rare. And so, what I'm talking about is objecting to dividends generally as a rule. There will always be exceptions. So, not only that, just leave you on a couple of other small thoughts. So dividends are incredibly tax efficient. They're paid out of taxed corporate earnings, and then they're taxed again as income when they're received by the shareholder. And this is the reason that Henry Singleton refused to pay dividends when he was at Teledyne. He said, why do investors want double taxation? They're far better off for me reinvesting this money for them. And then finally, and I'm going to leave it here, and I know I've given you a really long answer, but there is no one-size-fits-all dividend policy. Do all shareholders require the same amount of income? And those that do, will they all require that income to be paid at exactly the same point in time? Of course not. Which is why, Warren Buffett, when he's been challenged on why Berkshire doesn't pay dividends, has always argued that, great companies shouldn't pay dividends. They should optimize compounded growth. And if individual shareholders require cash, they can choose to sell down a portion of their holding at any time that suits them to manage their taxes most efficiently. So, sorry for the long-winded answer, but, I hope that's answered your question. Maybe it's changed your opinion on dividends.
No, it's this is a podcast called Compounders, so we are clearly biased towards businesses that have long reinvestment runways and choose to allocate capital accordingly.
Great, we're on the same page.
I also know that you have a very special place in your heart for stock-based compensation, and it's a topic you cover as well in your writings. Why do you call stock-based compensation the most abused aspect of corporate finance?
Well, you've gone and opened a Pandora's box there. That's a topic that could have its own dedicated podcast episode. But let me try and answer you relatively concisely. So, stock-based comp. How did it all start? It had its roots in the startup arena. So, if you launch a bootstrapped company, it's not yet profitable, cash flow is negative, but you need talent to succeed. So, what do? The answer is simple. You offer sweat equity. The pitch to talented people is, let's do this thing together, let's make this work, and we can all share in the value that we create. That makes so much sense, and that's how stock-based comp started. But the important part there is that the stock-based comp is in lieu of salaries instead of salary. Now, fast forward to today, and what we find is companies that are uber successful, swimming in cash, are paying their people huge cash salaries anyway, with great benefits attached, and they still find it necessary to issue stock-based comp. Companies like Apple and Google and other tech giants are the worst offenders. Now, they may argue that they need to offer stock-based comp to attract talent. Do you believe that? Not only do these companies have gold-plated reputations and represent great places to build a career, but they offer legendary perks. Google has been voted one of the best places to work. So, as far as I'm concerned, that argument doesn't really pass muster. Then these companies will argue that stock-based comp allows them to defer OPEX in the form of salary, which enables them to accelerate growth. But these companies are sitting on mountains of cash. They don't know what to do with most of this cash. So, that really doesn't pass muster either. And in any event, equity financing is the most expensive kind of financing. And it's normally used as a last resort once cash and debt options have been exhausted. So, that makes no sense either. The true cost of equity grants that are issued isn't known at the time that they're issued. It's only discovered later when they vest several years into the future. And so, they're rewarding insiders with blank checks. And that often works to the detriment of external shareholders. It's almost a transfer of wealth from external shareholders to insiders, which I don't like very much. It's not particularly tasteful. And on that subject, how are external investors supposed to evaluate corporate accounts when the numbers recorded for stock-based comp at the time of issuance are invariably incorrect and unreliable, and only a fraction of the ultimate cost? what that does is it flatters earnings numbers and distorts corporate valuations, which isn't really good. It's not very good. But it gets worse. It gets much worse. So when stock-based comp vests, the company will repurchase shares to offset dilution. So they're using shareholder equity to offset that dilution. They're not returning value to shareholders. And no matter how it's presented, it's not good for shareholders. It actually destroys shareholder value. So first, the stock-based comp is typically granted at a discount to full value. And when it vests, the company repurchases shares in the open market, often at a premium to intrinsic value. So that is a buy high, sell low strategy. It's the exact opposite of what any competent CEO ought to be doing. And second, if the stock is trading at a value above its intrinsic value, then buying it back destroys shareholder equity, because for every $1 spent, less than $1 of value is being received. And so, all of this is really, really bad for investors. But that is still not the end of the story. So, if you look at any segment of the stock market, whether it's retail investors or institutional investors, the pricing equilibrium ensures that buyers and sellers are relatively balanced. But the same isn't true for companies buying back their own stock. And they buy back their own stock regardless of price. They're not in the market selling, they're only buying. And in 2019 alone, US corporates buying back their own stock to offset dilution from stock-based comp amounted to an inflow of $4 trillion into the stock market. And to put that in perspective, back in 2019, the total market cap of publicly traded US companies was around 34 trillion. So this artificial demand amounted to almost 12% of the value of the market. So, how do you think that impacts share prices? It distorts share prices. And the truth is that market valuations have become detached from underlying fundamentals because of these distortions. And the situation has been exacerbated by passive investing. So, as market caps are inflated through these buybacks, these companies end up with a larger weighting of the index, and passive funds are compelled to increase their holding. And that pushes the values up still further. And then the cycle repeats when the next wave of stock-based comp vests and the company comes back to offset dilution, once again. So valuations become more and more and more stretched, which is why we've got this massive dislocation between the large caps and the small caps. I don't think it's ever been quite so wide as it is at the moment. Just look at the difference between the Magnificent Seven and the Russell 2000. So, Buffett favors looking at market cap to GDP as the best single measure of how valuations stand at any given time. And the long-term mean is about 83%. And the market's always oscillated around that kind of level until about 2012, when stock-based comp really started to accelerate and really started to become a problem. And today, so bear in mind that ratio, market cap to GDP, the long-term average is 83%. Today, it stands at an all-time high of 197%. That's almost 2.5 times the long-term average. It's unprecedented, and it's starting to look a lot like a bubble that may ultimately burst. Maybe so. Just going back to the stock-based comp thing. So we discussed a few things. Apple and Google and why they're doing it. And it's not that they need to attract talent because they're quite attractive companies to work for, and it's not that they need to defer OPEX because they're sitting on mountains of cash. So what is it? What is this all about? Maybe it's an antitrust issue. Maybe they think to themselves, by offering great salaries and stock-based comp, startup challenge companies that are coming into the industry as startup challenges that may otherwise disrupt the industry, those people will struggle to secure the talent they need just because the stock-based comp effectively acts as golden handcuffs to keep people locked in. So maybe that's the issue. And maybe back in the day, one tech company tried to be smart and offer stock-based comp to poach great people from the other big tech companies, and that would have ultimately led to some kind of a reciprocal measure where each company is trying to offer slightly more than the next, and so bit by bit they're digging themselves into a really deep hole. And now it could be that they're in so deep that they simply can't climb out. And just to give you an idea, every year these companies issue more and more stock-based comp than the year before. So last year, Apple awarded its employees over 11 billion in stock-based comp, and Google trumped that. It exceeded 22 billion. And as a percentage of revenue, stock-based comp is growing faster and faster and faster. So maybe this is an area where the regulator needs to step in. I think they've been asleep at the wheel. Just to give you another good example, Palantir. Everyone raves about Palantir being a wonderful company. A couple of years ago, it IPO'd, and after it went public, its stock-based comp amounted to 120% of top-line revenue. That's not 120% of earnings. That's 120% of top-line revenue. There's no excuse for that. When insiders are taking more value out the back door than customers are bringing in the front door, there's no hope for shareholders. It just isn't sustainable. And think about this. Twitter had its IPO in 2013, and post-IPO, its shares traded around $45. A decade later, Elon Musk took Twitter private, as you know, and he took it private at about $45 per share, pretty much the same price at which they IPO'd a decade earlier. So this is a company that pays no dividends And so shareholders have seen zero returns over a decade. It was a really disappointing, miserable time for shareholders. In fact, accounting for inflation, they made a loss in real terms. Meanwhile, insiders had been awarding themselves stock-based comp every step of the way. And Jack Dorsey, the CEO of Twitter, prior to it being taken private, took his personal wealth from zero to about 4.5 billion. So the shareholders in his company have earned nothing, zero returns, negative adjusted for inflation. Meanwhile, he's a multi-billionaire. Is that right? Or is this really, as I said at the beginning, the most abused aspect of corporate finance today? Contrary to popular opinion, stock-based comp doesn't align the interests of insiders with outsiders. If you and I buy a share in a company and we're there for the long term, we want it to compound, we're a buy and hold investor. When you give stock-based comp to an insider as part of a remuneration package, they're not buyers, they're not long-term holders. They are minded to sell and cash out at the first possible opportunity when the thing vests. So how does that align interests? It doesn't align interests at all. So I cover this issue and the dividend issue in separate chapters in my book and in various Substack posts that I put out. So for anyone listening interested in more detail, I go into a lot more detail there.
And you mentioned that you've written books about investing. I'm curious about, kind of a two-part question, why you decided to write books about investing. And then we'd love to hear about your recent book, Fabric of Success.
Okay. I've got a copy of it here, if you can see that. So this is available on Amazon if anyone's interested. So I regularly engage with C-suite executives, as I've already mentioned, and I raise constructive challenges where a decision or a course of action makes little or no sense to me. So it could be dividends, could be stock-based comp, it could be recruitment or expansion in new geographies, could be anything. And this has happened hundreds, probably thousands of times across my career. And it often feels like Groundhog Day because I'm raising the same challenges again and again, albeit to different CEOs, different CFOs. But the really interesting part is that the response that I receive, most of the time they say something like, wow, I've never looked at it like that before. Well, that's an interesting perspective. And even more interesting is that, this kind of discourse that I have with C-suite executives typically brings about change. They may have a beneficial pivot in a different direction, which is beneficial to the company. And I'll give you an example. I won't mention the name of the company, but I had a conversation last year with the CEO of a British blue chip company, which the CEO, it was a lady, and she had been on record time and time again saying, the stock is undervalued on a sum of parts basis. It just doesn't make any sense that it's trading at such a massive discount. Meanwhile, she was paying huge dividends and there was no stock buybacks, nothing at all. I jumped on the call to her and I had a conversation and I asked her about her capital allocation policy and suggested that it might be more beneficial and more accretive to investors for her to reduce the dividends and to start buying back shares. And we certainly send a message to the market about the company's view on the intrinsic value of the company. And she did it. She took the advice and she did it. And since then, the company's up 25%. So, don't get me wrong. I don't claim to be a guru of business administration. Everything I know, I've learned from other people. I read biographies, autobiographies. I listen to podcasts. I speak to CEOs and CFOs, and I raise objections, and they come back with counter arguments. And all of this accumulated knowledge is really valuable. But the advantage I have as an investor over a corporate CEO is, what I would refer to as peripheral vision. So a CEO is going to know everything about his own company. And one would hope that he'd be an expert on the industry in which he operates. And he may have limited knowledge about the businesses of his competitors. But think about that. That's a really narrow field of focus. Now, contrast that to an investor who constantly analyzes all sorts of businesses in different industries, different countries. Now, the investor is going to be reading quarterly and annual reports and engaging with other investors, and he's going to come to learn, what works and what doesn't work. His field of focus is far broader than the average CEO. So it's no surprise that a good investor is able to introduce new perspectives to corporate management. So I thought to myself, well, how valuable would it be to capture these perspectives in a book, supported by examples, not my opinions, but examples of where eminent CEOs, highly successful CEOs, have successfully deployed particular strategies to really great effect. And so I captured all of this in the book, and I published the book, and I'm really flattered that the book has received critical acclaim. In fact, it was compared by one critic to The Outsiders by William Thorndike, which I'm flattered by because it's one of my favourite books. Now, I take a different approach to Thorndike in The Outsiders because, rather than looking at great CEOs sequentially, one at a time as he did, he broke down, eight legendary CEOs. I chose to break the book down thematically. So I've got 53 chapters. And I explore in each chapter how a far larger number of ultra successful entrepreneurs, I delve into the businesses of about 150 very successful entrepreneurs, how they've tackled different issues, from capital allocation to recruitment, how they create a unique culture, their corporate constitution, how they manage their costs. Many of them are very frugal, how they develop new products and services, how they create brand power, decentralize their operations, how they avoid bureaucracy, succession planning, how they arrive at a coherent dividend policy, perhaps they don't pay dividends at all, and how they align interests with insiders and outsiders, how they manage customer relationships, for instance, and how they structure their internal operations, their processes, so on and so forth. You get the idea. And the result was really fascinating because, despite looking at 150, 160 different entrepreneurs, and despite spanning different eras, and these entrepreneurs being located in different geographies and operating in different industries, so many of these people converge on a very, very similar approach. And that approach yields exceptional results. Now, importantly, these people didn't all start with similar methods, but that's where they ended up. They all learned what worked through their careers, through a combination of trial and error, mixed with an insatiable thirst for knowledge and a passion to constantly improve. So that they weren't afraid to break from convention. Being better means doing things differently. And despite being unconventional, this small group of high achievers still ended up operating in a very, very similar manner. They kind of converge on the same path, which was really, really interesting. So, when writing the book, which I've called Fabric of Success, the objective was to pull on the golden threads that run through the fabric of every great business. And I'm really exceptionally pleased with the result because, as I say, it's been really well reviewed. But the book wasn't only written for CEOs. It's also aimed at equity investors because it helps create what Charlie Munger would call a lattice of mental models with which to evaluate companies and their management. This is all qualitative stuff, and it's so important and valuable. Too many investors become obsessed with plugging numbers and assumptions into spreadsheets, calculating discounted cash flow models, but they miss the most important aspect. Reading accounts and understanding numbers is important, but we should never lose sight of the fact that the accounts are a man-made construct. They're an artificial presentation of reality rather than being reality itself, and the distinction is really, really important. You can't discover a new city by studying it on a map. You may find how to get from A to B, but it won't tell you which neighborhoods to avoid or where to hang out to have the most fun. That requires a different level of qualitative analysis. And the same is true when you're analyzing a company. So that's where my book, Fabric of Success, becomes, I think, an invaluable tool for investors. The key, and a thought I'd like to leave you with on this subject, is that successful investing is all about the approach to management. The same company with a different management, in my opinion, is no longer the same company. So, just think about a few quick examples. So, Scully went to manage, he left Pepsi, he went to Apple to manage Apple. And he took the company almost to the point of bankruptcy. They had 90 days cash flow left before they'd have had to declare bankruptcy. Scully was pushed out, Steve Jobs came back in, same company, same target market, same product base. Apple is now one of the biggest, strongest companies in the world. So same company, different management, completely different outcome. And, flipping that on its head the other way around, think about Thomas Watson. He built IBM over the course of about 80 years with his son into it was at one time the most valuable company in the world, Big Blue. Couldn't do anything wrong. Nobody could touch it. It was actually investigated by the DOJ a couple of times because it was so big and it had so much kind of monopolistic power. Now, all of a sudden, in 1993, Lou Gerstner was brought in to become CEO. Now, he came from RJR Nabisco, which was a biscuit company. Now, this rhymes with Apple and Scully, right? Scully has come from Pepsi. That's a commoditized business. What did Scully know about the tech world? He knew nothing, which is why he nearly crashed the business. Similarly, Lou Gerstner has come from a biscuit company and he's stepped into IBM. What on earth does he know about running another tech company? And it's no surprise that he was there for 9 years and he really caused irreparable damage while he was the CEO. If you're interested, I can go into more detail, but that's probably a conversation for another day. There's so many other examples. I'll give you two more before we kind of wrap up. So Dick and Mac McDonald. They established the McDonald's idea in San Bernardino, California. But they were happy having this one restaurant. They had a really nice lifestyle. It was providing them with good cash flow. They used it as a cash cow. They were really, really happy. All of a sudden, Ray Kroc discovered this wonderful concept. It was a new concept back then. Fast food didn't exist before then. And he wanted to scale it up. He wanted to create this franchise right the way across the US and ultimately globally. And Dick and Mac McDonald, they weren't interested, and it took a great deal of convincing. And ultimately, Ray Kroc convinced them to do it. And it was Ray Kroc's involvement that created McDonald's as we know it today. Had he not come along, same company, same target market, same concept, same product, it would have still been a single restaurant in San Bernardino, California. We might never have known McDonald's. And one final one, which is kind of a really interesting one, is that the airline industry is notorious for having consumed more capital over its existence than it's ever created. And most airlines, because it's a commoditized product, and when you and I decide on flying from city A to city B, invariably we're going to go for the lowest cost. We're not particularly loyal to brand, and that's part of the problem really that the industry has. And so most airlines have kind of fluctuated in and out of profitability. And to give you some context, Delta Airlines only ever managed in its history 10 years of consecutive profitability before it then dropped back into loss. American Airlines only managed 7 years, and United Airlines has only ever managed 3 years. Now, against that backdrop, think about Southwest Airlines. Now, this was no different to the other airlines, right? This is a commoditized business, as we've discussed. Now, Herb Kelleher was a genius. He managed the business entirely differently to the other airlines. And he managed 47 years of uninterrupted profit. And the interruption only came when the COVID pandemic struck, right? And everyone was locked down. So there was nothing he could have done about that. So, again, similar business, different manager, different CEO, and the result could be more different. So that's really what the book's all about. It's all about pulling the fabric of success, pulling the golden threads out of that fabric of success to identify what makes a great company. And if we use that as a framework as investors, once you understand these golden threads and what they look like, then when you're analyzing other companies, you can immediately say this one looks like a good one, that one's not going to work. So that's in a nutshell what the book's all about.
And we've talked a lot from a high level about your strategy and the subjects you care deeply about and your deep study of historically successful and unsuccessful businesses. But we haven't really talked about any individual companies yet. I'd love to hear about a past investment that you think represents a prototypical Rock and Turner stock.
Sure. Well, actually, I'll give you a good example, and it's not even a past investment. It's a position that I have at the moment. And this kind of encompasses everything we've spoken about today. So it's one of my very high conviction long-term holdings, and it actually takes a large part of my portfolio at the moment. So this is a Dutch company. So we're talking about global diversification. I look anywhere. This is a company listed on the Amsterdam Stock Exchange. And in my opinion, it's a jewel among European companies with a market cap of 46 billion. And it's got 9 billion cash on the balance sheet. No debt. The company's called Adyen. You probably heard about it. And it's run by one of its founders, a guy called Dutch guy, Peter van der Does, who's passionate and obsessive about the business and what he does. In fact, he's about as passionate about Adyen as Steve Jobs was about Apple, which was another key thing that really attracted me. I'm talking about the golden threads. I see golden threads in this company. So, Peter van der Does, he recently stated that the board still oversees every single hire. This is a company that has, 4,000 employees, I think, at the moment. Regardless of role, the board still oversees every single hire. And he says you can't be hired at Adyen without speaking to one of the 6 board members. And he said the reason we do it is to put a really high bar to ensure that only the best talent joins Adyen. And Steve Jobs was exactly the same at Apple. When he came back after Scully was pushed out, he said, I only want A-list players. And he pushed out anybody who didn't meet the grade, and he brought in just A-list players. And he speaks about A-list players, and that's exactly what Adyen do. So again, another golden thread. So Adyen has a really interesting backstory. I'll just kind of give it to you if you're not familiar with it. So the founding team, including Peter van der Does, have a history of serial entrepreneurs. So they helped develop a business called Bibit Global Payment Services, and it was developed back in the 90s, and it was acquired by the Royal Bank of Scotland in 2004, and then Bibit was integrated into WorldPay, which was part of the Royal Bank of Scotland group, and Peter van der Does was contractually obliged to remain involved in that business for 2 years as part of an earn-out. And he recalls that while he was there for those 2 years at WorldPay, they were making all sorts of decisions that he would never have made. And he learned what works and what doesn't work and what the problems were in the payment industry. But more importantly, he formed this idea of what he would have done differently if he could wind the clocks back and start Bibit all over again. He knew that existing payment technology at the time consisted of a patchwork of systems built on outdated infrastructure, and he knew it could be so much better. So at the first opportunity, when the 2-year kind of earn-out period, the lock-in period expired, he left WorldPay, and he did exactly what he intended. He started again. And this time he vowed to do it even better second time around. And the name of the company, Adyen, it means start again in the Creole language. So that's where the roots are. And he's obsessed with delivering the highest quality product and customer service available. And arguably, he's delivered on that. And he's still with the business today. And all of the metrics trend higher sequentially. Top line growth is really impressive. The rate at which the company is scaling, equally impressive on a global base. Headcount is growing rapidly due to the size of the addressable market and the demand for the product. Now, there are lots of payment services out there. But most are targeted at individuals or mum and pop shops. Think about PayPal and Stripe, for instance. Adyen doesn't really play in that market. He doesn't compete with those guys. Its target is the large enterprises. So it actually displaced PayPal as the payment service for eBay. So all eBay payments now are through Adyen. And it also provides payment services for Microsoft, Hugo Boss, Netflix, Uber, Facebook, Airbnb, Spotify, Gap, Tiffany & Co, McDonald's. All the big names are coming over to Adyen because its service is so far superior to anything else on offer at the moment. And it's a market leader. It's offering a differentiated service. It's got a full stack. Which is a real distinct competitive advantage for merchants, because it's often cheaper and more convenient to use Adyen with this full stack rather than having multiple contracts with payment gateways, processors, acquiring banks. And there really isn't another company able to compete. Nobody else has that kind of technology, which is why it's winning all those big logos as customers. And the business is really incredibly sticky. Once you've got this kind of payment system integrated into your business, with your McDonald's or Spotify or whatever it might be, or eBay, and you've got your online payments with your store payments, and they're all kind of linked together. It doesn't make any sense to kind of switch. That kind of comes through because it's got really strong double-digit year-on-year sequential growth, and it has had since its inception. And most of that has been organic. Well, all of it's been organic. It's never made an acquisition. In fact, when asked about acquisitions, it effectively says that it has a very particular culture and it likes its way of doing things, and it doesn't think that it can integrate another company that has its own established ways. It rather grows organically, which is kind of a wonderful thing. So capex expansion spending has been high since the beginning of the decade, and it's pretty much almost doubled its employees year on year. But that's now mostly complete. It believes that now most of that capex spending, and it's got enough employees to meet its needs for many years to come. And so operating leverage is about to kick in. And so you're going to see margins expand significantly in the years to come. So in terms of reach, Adyen's success took root in Europe. But now, as I've already explained, it's a big international business. It's growing fast everywhere, including the US, some of the names I've given you. So the company, as far as I'm concerned, is just at the start of its journey and plans to offer services in other segments, including offering banking as a service. The company pays no dividends, which, as you know, is music to my ears. And its stock-based compensation is really, really limited. It's not at all egregious. Balance sheet is solid. It's got 9 billion in cash, no long-term debt. Gross margins are constantly between 60 and 70%. Operating margins in the mid-40s. And they're kind of heading towards the 50s. Return on invested capital, mid-20s, but expected to move closer to the 30s. This is a serial compounder. I honestly expect to hold this stock for as long as Warren Buffett has held American Express.
Well, that's a good example, and it does highlight a number of the threads that you've pulled out, whether it's the dividend side or the lack of stock comp. So that's an interesting example. James, this has been such an interesting conversation. We went really deep on a number of subjects. I think people get a really good sense for, who you are as an investor and a philosopher and a writer. So I appreciate you being on Compounders. Thanks so much for your time.
Thank you for having me. It's been great. Really enjoyed it.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.